Okay, let's dive in. The stock market. I think for so many people, maybe even for you listening right now, it just feels, well, inaccessible, doesn't it?
Oh,
Like
absolutely.
this, I don't know, secret club. Only for the really wealthy, the folks in suits you see yelling in movies.
That image is incredibly strong. Yeah, it pops in your head almost instantly. But it's an image that the source material we're looking at today really tries to push back on, like right from the start.
Right.
It makes a point of saying, look, the stock market isn't some, fortress guarded by dragons or anything.
Yeah, the source gets pretty relatable there. It actually calls the stock market a great equalizer, which that's a really interesting phrase. It puts it in the same bucket as things like the subway,
Yeah.
available to anyone who can get to it. Or maybe a bit less cheerfully, the flu,
Right. Accessible to everyone, unfortunately.
meaning it's out there, it's reachable, no matter your background, basically.
Exactly. That accessibility is, well, it's key. But, and this is the really crucial part, the source highlights. Just because something's available doesn't mean everyone automatically knows how to, use it effectively.
Okay.
Like your subway example you can get on, sure, but knowing which line gets you where you need to go,
Yeah.
that's a whole different skill set.
Yeah.
And knowing how to avoid the flu is definitely a skill.
Yeah, definitely. So that navigation piece, that's what we're focusing on today. We're doing a deep dive into this specific source you brought us, the Money School, and we're zoning in on pages 24 through 41.
Hmm.
Our mission really is to cut through all the noise, try to understand the absolute fundamentals. How does this thing work? Then look at its, well, surprisingly wild history,
What?
and then sort of ground ourselves in what it actually looks like today. We're just pulling out those essential nuggets, the key takeaways from this particular section.
Yeah, think of it like this. The source compares understanding the market to baking a really complex cake. You can see the beautiful picture on the box, right? The get-rich dream, the finished product. But if you don't actually have the recipe, if you don't know the steps, or crucially understand why you add the eggs before the flour, you're probably going to end up with well, the source calls it a culinary disaster.
Right. A flat cake.
Exactly, a flat, unappetizing mess.
Yeah.
And this deep dive. It's about getting that foundational recipe right.
That's a really good way to put it. So let's kick off with a question that I bet resonates with a lot of you listening. Have you ever felt like maybe investing just isn't for you? Like it's too complex, or maybe you've kind of missed the boat. It's just too late to even start thinking about it. Those feelings are so, so common, almost universal, I'd say, for people new to this. And this source tackles them right away.
It really does. And it starts by laying out what it calls the wrong way of doing things with money versus what it calls the winning way.
Okay, the wrong order. This sounds, yeah, painfully familiar for a lot of folks, probably. It's described as work for money, get the money, spend the money, and then that's it. End of story.
Yeah, just a cycle.
Mhm.
Focused entirely on earning and then consuming what you earn.
No growth built in.
Exactly. A very traditional path, maybe, but one that doesn't really factor in the potential for that money to grow on its own. The source argues the winning order as one crucial step.
Yeah.
Work for money, have the money, and then invest the money.
Right. And the absolute core reason why adding that invest step is the winner, the key concept you really have to get your head around, is the time value of money.
This is it. This is foundational. It's the simple but actually really powerful idea that a dollar you have right now, today, is worth more than that exact same dollar if you got it, say, a year from now.
And the logic is pretty clear when you stop and think, right, that dollar today, you can put it to work immediately. It can start earning something, start growing. If you wait, well, it's just sitting there, not doing much.
The source uses this wonderful analogy, totally outside of finance, that really makes it stick. It's like planting a seed.
Okay.
Do you plant today, or do you wait a year to plant that same seed? If you put it in the ground today, it starts its journey right away. It starts growing. The sooner it's planted, the sooner you get sprouts, leaves, maybe eventually fruit. Money, the source argues, works on a very similar principle.
I like that. That makes a lot of sense. So you know the old saying, money doesn't grow on trees. The source kind of flips it a bit. It says, well, actually, money can grow in the stock market. It calls the market fertile ground for your money. But, and this is the big but.
Yeah, the important qualifier.
It only grows if you actually plant it. You have to take the action. You have to invest it.
Right. And look, the source isn't promising you'll get rich overnight. That's not the message. But it emphasizes that whether your goal is, massive wealth or just building enough security for a comfortable future, the stock market historically speaking, is presented as one of the most effective ways to do that over the long term.
But this is where the source gets really practical and honestly a little bit tough. It immediately pushes back on all those shiny, get-rich-quick promises out there. It acknowledges how incredibly tempting they sound.
Oh, they're designed to be tempting, aren't they? They prey on that desire for instant results. The source lists a bunch of examples that have been huge lately: crypto, NFTs, Forex scams, drop shipping stuff, affiliate marketing. And it's pretty blunt. It basically says these generally aren't the real reliable ways to build lasting wealth, not compared to strategic long-term investing anyway.
And that's where that baking analogy comes back, right?
Exactly.
You see the picture of the amazing cake, the get-rich result. But if you just look at the picture or, listen to some random person on TikTok giving you a fail-proof formula.
Yeah, with no real substance behind it.
And you try to bake it without the detailed recipe, without understanding the steps or why you add things in a certain order.
You're almost guaranteed, the source says, to end up with that culinary disaster. You might forget a key ingredient, mix things wrong, and poof, a flat, unappetizing mess.
And the source really drives this point home. It says diving into the stock market with only that superficial cake picture level of understanding is just like that baking disaster. If you don't get the underlying principles, the strategies, the how and the why, you're, well, in the source's view, very likely to fail.
And the consequences are way bigger than a ruined cake, right?
Right.
The source is clear. Failing in the stock market because you didn't understand what you were doing or because you just jumped in impulsively. The stakes are much, much higher than wasting some flour and eggs. It takes, study, preparation, following a method, not just crossing your fingers for luck.
Okay, so if understanding the time value of money is the core why and avoiding the flat cake is about understanding the how, what about the mental game? Because, let's be real, even knowing this stuff, there are huge mental hurdles. The source has some great insights here, starting with this idea it calls sweat your cash.
Yeah, this is about really internalizing the potential that every single dollar you have holds. The source points out that financially savvy people, or just folks who've learned these lessons, understand something called the cost of capital, which is basically the earning power your money could have if you put it to work effectively.
The analogy here is pretty powerful. Leaving your money just sitting in a standard savings account, earning basically nothing. That's compared to having like a superstar employee, someone with amazing potential, but you've got them doing some totally mindless basic task. Their talent is just wasted.
Exactly. Whereas investing that money in stocks, bonds, whatever, is like giving that superstar employee a really challenging, high-impact job where they can actually use their skills and make a difference. Financially, that translates to potentially much higher returns. You're making your money work hard, making it sweat for you.
And connected to that is this encouragement to question everything. The source really urges you, the listener, to be like that contrarian kid in the classroom.
Yeah, the one always raising their hand, pushing back a bit.
Yeah. Right. Think for yourself. Use what you know about you and your situation. And don't be afraid to question things, even if they come from an expert like the author of this very book.
That critical thinking is so, so important. You can absorb information, like everything we're talking about today, but applying it well means filtering it through your own lens, not just swallowing everything whole without thinking about it.
Okay, so let's put on that contrarian hat for a second. They might lean in and say, all right, fine, investing is better than saving, you say. But saving feels safe. I know my money's there. Why should I risk it in the market instead of just, hiding it under the mattress?
Yeah.
Or, in a savings account.
And the source hits this head on with the numbers. It acknowledges, look, a high-yield savings account, especially when interest rates are up, is way better than a traditional barely any interest account.
Definitely better than the mattress.
Oh, yeah, miles better. But even with a decent savings rate, you're still potentially missing out on significant growth over the long term compared to investing.
This section specifically talks about that historical comparison, right? A potential, say, 7% inflation-adjusted annual return. That's often cited as a long-term average for stocks. Now compare that to maybe 1% a year from a typical savings account over decades.
Yeah, the difference is huge when you let it compound over time.
Yeah.
That extra 6% year after year after year, that's your money really sweating in the market compared to just kind of lounging around in savings.
Okay, so the numbers make sense, but then the source gets into those big common fears people have, the stuff in Chapter 1. These are powerful mental blocks.
Huge ones. Fear number 1, I'm too old. You hear this all the time. especially from people who feel like they're finding out about investing later in life. The source just hits back with a simple truth. You're never, ever going to be younger than you are right now.
Right. Today is the youngest you'll ever be again.
Exactly. And time. Time is the absolute magic ingredient for investing because of compound interest.
It's like that seed needing time in the ground.
Precisely. The longer it compounds, the more powerful it becomes. Fear number 2, I don't have enough money. People think you need like tens of thousands to even start. The source says absolutely not. You don't need to be rich to begin investing.
Okay, so what do you need then?
What you really need, according to the source, is the most amount of time you can possibly get working for you. Starting small, even with just a little bit, but doing it consistently over many, many years. That's way more impactful than waiting until you have a big lump sum, but starting much later.
And the third big fear, I'm just not a numbers person.
Oh man, this is relatable for so many. Spreadsheets, charts, jargon, it makes people's eyes glaze over. But the source tackles this with a great personal story from the author.
Yeah, this is powerful. The author admits they started their journey not as some finance whiz, but as, and this is a direct quote, a freaking poetry major.
Ah, that's brilliant. It really is.
Yeah.
Because it just demolishes that idea that you need a certain kind of brain or background. If someone focused on metaphors and rhyme schemes can figure this out, then really anyone with the curiosity and willingness to learn can too.
Then to really hammer home the incredible power of time, even more than the starting amount, the source gives this very specific concrete example. It compares 2 people investing the exact same small amount, just $100 a month.
Yes, it looks at someone who starts putting that $100 away every month consistently, starting when they're 25 years old, and compares them to someone who waits just 1 decade, starting the same $100 a month when they're 35.
Okay, same amount per month, just starting 10 years later. And the difference by the time they both hit age 65, honestly, it's shocking.
It really is. The person who started at 25, just doing that $100 a month, they end up with around $389,377.
Wow.
The person who waited until 35, investing the exact same total amount out of their own pocket over the years, they end up with only about $189,476 by age 65.
Wait, that's a $200,000 difference.
Just about. Over $200,000 more for the person who started 10 years earlier. And they didn't invest a penny more per month. The entire difference comes from that extra decade of compound interest doing its thing, building on itself.
That one example basically blows the too old and not enough money fears right out of the water, doesn't it?
Probably the most compelling case you could make. Time is your superpower here, way more than a big starting pot. But the source also goes deeper into something that often doesn't get talked about enough. The emotional baggage around money. It talks about money trauma.
Yeah, that phrase really stood out.
For people who grew up, without much money or experienced real financial instability, the whole idea of investing can feel, as the source puts it, absolutely terrifying.
And triggering. It brings up things like imposter syndrome, too. If you felt the anxiety of lack, putting money into the stock market, a place where, yes, there's risk you would lose it, feel incredibly dangerous.
Right. Your survival brain might be screaming, no, keep it close, keep it safe. Putting it somewhere it might go down feels totally irrational based on past experience. The author shares really openly about this, admitting they felt physically sick early on just thinking about losing money.
And the imposter syndrome, feeling like you don't belong in this world. The author shares that internal voice. Who was I, a child of immigrants with zero investing experience, to even think about Wall Street? There's even that funny but really telling story about not knowing what ROI meant at first.
Yeah, mistaking it for REI, the camping store.
Exactly. It perfectly captures that feeling of being completely lost in a new language, a new culture.
And the source then clarifies, okay, ROI is return on investment. On Wall Street, it measures how much your money grew. But it also makes a broader, wiser point. Sometimes the biggest ROI isn't financial. It's investing in yourself.
Yeah.
Taking the time to learn, reading a book like this one, taking that scary first step.
So dealing with that anxiety, that potential trauma, or feeling like a fraud, that's step 1, really, before you even think about clicking buttons. And speaking of easing anxiety, the source offers another angle. You might already be an investor and not even know it.
This is a really big one for millions of working people, especially here in the U.S. Think about employer retirement plans like 401k. They hold trillions of dollars collectively. And they aren't just savings accounts. They are, as the source says, intricately linked and deeply invested in the stock and bond markets.
Right. Those plans usually put your money into a mix of stocks, mutual funds, which are just baskets of stocks and bonds themselves. So if you contribute to a 401k from your paycheck, which tons of people do, you are automatically funneling your money into the market. The source is very clear. If you do this, you're already a very willing investor. Your money's in the game, working behind the scenes, often without you consciously choosing individual stocks. Now, the takeaway isn't, okay, cool, I can ignore it then. No. The source really encourages you to shift from being passive to taking an active role, acting with intention. Why? Because, and this is a great line, no one is going to care more about it than you.
Exactly. You got to grab the steering wheel for your own future, even if you were kind of put in the passenger seat automatically at first.
But acting with intention is the opposite of acting on impulse. And the source has a whole section called Fools Rush In, a pretty direct warning against emotional, uninformed moves.
Yeah, just because you now hear about that potential 7 or 10% historical return, don't just panic and dump your entire life savings into the market tomorrow morning based on that one number.
That sounds like a recipe for disaster.
It often is. Rash choices, especially when you're new, are far more likely to lead to disappointing returns or worse, losses. And that just reinforces all those fears you were trying to get past.
The internet, though, it's made things so much easier in terms of access, right? Online brokers, apps. The source calls them freaking amazing for how accessible they are.
Totally. Democratized access is a huge positive. But the flip side is that same ease can be dangerous. It can lead people to use these apps willy-nilly, like the source says, treating it like just another game on your phone, an app-delivered dopamine drip, chasing excitement instead of making smart choices.
So knowledge over impulse. The source brings in two really interesting quotes here to make that point.
Yeah, first from maybe the most famous investor ever, Warren Buffett. Risk comes from not knowing what you are doing. Simple, direct.
Okay. Makes sense.
Then a quote from Stanford Wong, who's a legend in the world of blackjack strategy, specifically card counting. Hunches will cost you more than they will gain.
An investor and a gambling expert, both saying basically the same thing. Know what you're doing, don't rely on gut feelings.
Right. The core message is similar. Be rational, be informed. But the source points out the difference isn't the message, it's the messenger. One's focused on long-term investing odds, the other on beating the house of cards in the short term.
And the source is pretty upfront that investing and gambling do have some things in common on the surface, right? Winners, losers, luck playing a part sometimes.
Sure, especially in the short term. But the whole point of learning about investing, the source argues, is to move away from relying purely on luck. It says getting savvy on investing strategy is like counting cards. Legally, of course.
Okay, I like that.
The idea is knowledge and strategy increase your probability of success over the long run, just like counting cards tilts the odds slightly in the player's favor.
The goal is to learn how to be more like the house, the casino, which has the long-term edge.
Exactly. And less like the player just hoping for lucky cards or a lucky stock pick. You want the odds on your side because you've done the work.
Okay, so that brings us to the system itself. How did we get this complex, strategy-focused, app-driven market? To really get it, the source takes us way back through the history of the stock market.
Yeah, when you hear stock market, what picture comes up? That Wall Street sign. A big fancy building. Leo DiCaprio yelling on a trading floor.
Probably one of those, yeah.
The source clarifies pretty quickly. If you're picturing a physical place, you're thinking of a stock exchange. The stock market itself is bigger, it's a system. The core idea is just giving money now, hoping to get more back later.
And this system, which feels so modern with apps and everything, has this incredibly long and pretty scandalous history, as the source puts it.
Oh yeah, packed with drama. The source mentions pirates, God, love, war, and money. It jokes that the early history could fit in the romance or true crime sections, not just business.
Definitely sounds more exciting than a textbook. So where does it start? The very beginning, in a way we'd recognize, is generally pegged to the 1600s, way before Wall Street as we know it.
And the source points to the company widely seen as the very first publicly traded company, the Dutch East India Company, huge global trading company.
What were they trading?
Mainly spices, which were incredibly valuable then. But the source makes a point to explicitly mention their heavy involvement in the slave trade, noting the abhorrent ethics tied to that part of their business. It's important context.
Absolutely. So publicly traded, what did that actually mean back then? And now?
Fundamentally, it meant the company decided to sell pieces of itself, ownership pieces, called shares to the general public. If you bought a share, you literally owned a tiny little chunk of the company. You might even get a fancy paper certificate.
And the people buying these shares were called?
Shareholders.
Yeah.
And the source clarifies that common confusion between share and stock. Stock is kind of the general term, like owning stock in tech companies.
Whereas shares are the specific units, like I own 20 shares of Apple.
Exactly. Shares are the pieces, stock is the collection or the general idea.
So how did those early shareholders in the 1600s make money?
Two main ways, the source says. One, the company might agree to give out some of its profits to shareholders. Those payments were, and still are, called dividends. Method two, a shareholder could just sell their shares to somebody else, another investor, hopefully for more than they paid. And this buying and selling between people,
Yeah.
that's what created the very first stockbrokers. And even though there were definitely scams and sketchiness back then, the source notes this basic system, companies selling shares for capital, investors buying shares for potential profit, it stuck around for hundreds of years. Why? Simple answer from the source. Because people were getting paid.
Makes sense. Money talks.
Pretty much. Investors made money, companies got funding. It worked, despite the flaws.
So this whole idea eventually crosses the ocean and lands in the U.S. around the 1790s.
Yep. And even way back then, Wall Street in New York City quickly became a major center for it all. But the trading, it was totally different. The source paints a picture. Mostly men, meeting right there on Wall Street, literally shouting out prices, auction style, trying to buy or sell shares, investors bidding.
It sounds like chaos.
Apparently it was. And that chaos, that unregulated street auction vibe, led to a really important moment in the late 1700s. A bunch of these brokers got fed up.
Fed up with what?
Scams, unreliable people, just the general mess. They worried it would make the public lose faith in the whole system. So they decided to organize. They met under a buttonwood tree, which is why it's called the Buttonwood Agreement.
Okay, the Buttonwood Agreement. What did they agree on?
The key thing, they agreed to trade only with each other, behind closed doors. No more random street options.
Ah, so it became more exclusive.
Exactly. The idea, the source says, was to block the sketchy sources and garner the public's faith by making it more orderly. But, and the source points this out clearly, it also shut out the regular person, the DIY investor who used to be able to just walk up and bid. Now you needed one of these brokers.
So it went from a public street market to a more private system in a centralized location.
Precisely. And that location, that formalized club, it became the New York Stock Exchange, NYSE, officially founded in 1792. Still, as the source calls it, the most iconic exchange in the world. It's often the image people have.
And nowadays, these exchanges are regulated, right?
Well, yeah. The source mentions modern exchanges in the U.S., like the NYSE, have to register with the Securities and Exchange Commission, SEC, which sets rules to protect investors. That came much later, of course, after some notable market crashes.
Right. So fast forward to the 1800s, technology changes things again. The telegraph comes along.
Huge leap. Sending messages practically instantaneously over long distances. Revolutionary.
And the finance world jumped on it.
Big time. They realized they could use it to relay stock info way faster. This led directly to the invention of this stock ticker apparatus.
The ticker. Like ticker tape parades.
Exactly. It was a machine that got telegraph messages with the latest stock prices and printed them out in real time on a long strip of paper, the ticker tape.
So no more waiting for slow mail to find out prices.
Right. Before the ticker, if you were, say, in Chicago, you were getting news from New York way late, you were always behind. The ticker gave almost instant updates, leveling the playing field a bit.
Though, as the source jokes, the internet made even the ticker look like absolute child's play later on.
Huh. Yeah, perspective changes things. But we still use the word ticker today, don't we?
We do, but it means something slightly different now.
Yeah. Ticker today can still mean that scrolling feed of stock info on TV symbol, price, up-down arrow. But mostly, when people say ticker, they mean the stock symbol.
The abbreviation for the company, like the source mentions T for AT&T, HOG for Harley-Davidson.
Or cake for Cheesecake Factory. Always makes me hungry.
Me too. So that's the unique code you use to look up and trade a specific company stock.
Exactly. So that gets us from the 1600s spice traders to the telegraph and ticker tape. Now, how it's going today. The source confirms, yep, the NYSE is still kicking, running since 1792.
Still a big deal, but the system's way more complex now.
Oh, much more sophisticated. The basic idea of a safe place to trade is the same, but there aren't just a few places anymore. There are many, many different stock exchanges.
And the source breaks down some of the main U.S. ones.
Yeah, because a quick rundown. The NYSE, still the biggie, lists lots of large, established industrial and financial companies. The source gives examples like GE, JP Morgan, JPM, Johnson & Johnson, J&J, Vis-a-vis, Verizon, VZ, IBM.
Kind of the wise uncle of exchanges.
Okay. And then there's NASDAQ.
Right, the NASDAQ. Historically unique as the first completely online stock exchange, no physical floor originally. It's mostly known for tech and internet stocks, growth companies. Think Apple, AAPL, Amazon, AMZN, Microsoft, MSFT, Meta, Facebook, FD, Tesla, TSLA. The source calls it the younger cousin.
Tech heavy. Any others mentioned?
Briefly touches on a few others with specialties. CBOE in Chicago for options and futures. OTC markets for smaller or foreign stocks traded over the counter. CME and NENMEX in Chicago and New York, focusing heavily on futures for commodities, energy, that kind of thing.
Okay, my head's starting to spin. Do I need like 5 different accounts for all these exchanges?
No, thankfully no. And the source makes a key point here. Which exchange a company chooses to list on. That's actually more important for the company than for you as an investor.
There's a funny bit in the source about picturing a Wall Street bro bragging his company is listing on NASDAQ. It matters for their image, their peers, maybe the listing rules.
But not so much for me buying the stock.
Not really, because of brokerages. Companies like E-Trade, Schwab, Fidelity, Vanguard, those are the names the source gives. They act as your gateway.
Okay, so the brokerage is the key.
Yes. They essentially compile the stocks across most heavy-hitting stock exchanges. So you open one account with a brokerage, and through them you can buy stocks listed on the NYSE, NASDAQ, wherever, all in the exact same way.
That simplifies things. The source uses another analogy here, right? The grocery store one.
Yes. This one really helps tie it all together. Think of your brokerage account as the supermarket.
Okay, my one-stop shop.
Exactly. Then the different stock exchanges, NYSE, NASDAQ, they're like the different aisles in the supermarket.
Like the produce aisle, the tech aisle.
Precisely. They organize the products, often by type. NYSE might be the big established companies aisle, NASDAQ the tech aisle. But crucially, you don't need to go to a different supermarket brokerage just to shop in a different aisle exchange. They're all under one roof.
And the companies themselves, Apple, J&J, Tesla.
They're the products on the shelves in those aisles. Lots of different products, companies, in each aisle exchange, but all available at your supermarket brokerage.
Okay, but wait. That contrarian listener might pop up again and say, hold on. If I can buy Apple stock at my brokerage, regardless of whether it's in the NYSE aisle or the NASDAQ aisle, why does it even matter which aisle the company chose? Like, why does the farmer care which aisle the apples are in at the store?
Good question. The source explains that the aisles aren't identical. Exchanges have different rules for being listed, different fees, maybe different reputations or perks of membership. So certain exchanges are just a better fit for certain companies.
Like the apple farmer knows apples belong in produce, not the frozen section.
Exactly. A tech startup might feel NASDAQ is the right aisle for them, culturally or structurally. An old industrial giant might prefer the NYSE aisle. From your perspective as the shopper, you don't necessarily need to obsess over why they chose that aisle. Just know the product, stock, is available at your supermarket, brokerage, and knowing the aisle exchange just helps you understand what kind of company it generally is.
Got it. So buying today is basically find the ticker symbol, like AAPL for Apple, type it into my brokerage search bar, find the product, click buy.
Pretty much that simple, yeah. Which leads to that funny warning in the source.
Oh yeah, don't actually go to the Apple store and try to buy Apple stock.
Please don't. Sounds silly now if you know, but the source has a nice reminder. Forgive your past self for not knowing stuff, but hold your future self accountable now that you do know better.
That's good advice. Okay, so this move to digital, away from physical floors, connects perfectly to shattering that Wolf of Wall Street myth, right?
Oh yeah, the yelling, the chaos, the paper flying, that whole intense image. The source basically says, yeah, that existed, but it is no longer the reality.
And the author has firsthand experience here.
Incredible story. They worked on the actual Chicago Mercantile Exchange floor when they were just 18 years old.
18. Wow.
Yeah. Admits they lied to get the job, felt like a total fraud, totally clueless about money, beyond never having enough.
What was it like back then? Was it like the movies?
So pretty much, the source describes the energy as this insane mix. A raging nightclub, a horse auction, and a Middle Eastern bazaar, combined. And the smell.
Yeah.
Unforgettable, apparently. AXE, body spray, testosterone, and Adderall.
Oh my God, you can almost smell it through the page.
Right. It was sensory overload. Their job was writing scripts from newswires, like Google launching Gmail or the first iPod coming out and reading them out loud to traders, sometimes standing on a crate to be seen. It was, in a word, chaos.
And they actually got physically moved.
Yeah, tells a story about being literally picked up and moved by an aggressive, maybe drugged-out broker in the middle of the frenzy.
Yeah.
Not asked politely, just lifted. It paints a vivid and kind of scary picture.
So how did trading even happen in that environment?
It's called the open outcry system. Apt name, the source says, maybe the most spot-on description ever. People stood in pits and literally yelled out the price they wanted to buy or sell at.
Just shouting. How did anyone understand anything?
Hand signals. A whole complex sign language, sometimes called arbitrage or ARB, developed to communicate buy-sell orders, amounts, prices across the noisy pit. The source describes it looking like a caveman primitive language, chest beating, flexing, specific gestures. It wasn't random, it was coded communication.
And the crazy jackets.
Part of it. Traders wore these ridiculous jackets, sequins, neon colors, wild patterns, specifically to be easily spotted and recognized in the chaos of the pit. The source jokes they were the real trendsetters back then, more than MTV.
It's an amazing image. But the key takeaway is
That image, it is no longer the reality for most trading.
no more wolves howling on Wall Street.
Exactly. Why the change? Computers. Algorithms can match buyers and sellers way more quickly and quietly without all the hullabaloo of a physical trading floor.
And the numbers back that up.
Dramatically. The source gives specifics. In the 90s, the peak of open outcry, the NYSE had about 5,000 people working on the floor. Today, it's down to roughly 500.
Wow, a 90% drop.
Huge shift. Technology completely changed the mechanics. As the author cheekily observes, you can barely smell the AXE on the floor anymore. It's digital efficiency now, not physical chaos.
Okay, so the market's quieter, more digital. That makes the final section we're covering feel really important, building your investing team.
Yeah, the source shifts back to the human side. It uses this nice, simple idea, shopping is always better with a friend,
Makes sense.
and applies it to investing. It strongly recommends finding a study buddy, an accountability partner, someone to go on this learning journey with you.
What are the benefits?
Having a sounding board, someone to bounce ideas off, and crucially, accountability. The source notes that just beating yourself up about money mistakes isn't helpful, but having a friend or partner gently keep you on track, that can be super effective. And this connects to a bigger point the source makes about the frustrating reality of money talk in our society.
They just don't talk about it enough.
Right. It contrasts it with other topics we do discuss, even controversial ones, sex, politics, especially after wine, the source jokes. But money, still totally taboo. And the source argues strongly, it doesn't have to be like that.
It uses that car buying analogy, doesn't it?
Yeah, perfect example. If you're buying a car, you'd probably ask a friend who just bought one for advice, right? Leverage the recent experience.
Of course, common sense.
So the source asks you directly, why wouldn't you do the same with investing? If you have a friend who's already doing it, why not ask them about it? Learn from them.
It seems so logical when you put it that way.
And the conclusion is powerful, keeping our financial lives locked away, secret from our support systems. It does nothing other than hold us back from bettering ourselves together.
So talking about it, learning together, sharing the struggles and the wins, holding each other accountable, that's presented as a way better path than trying to figure it all out alone in the dark.
Absolutely. It highlights that, yeah, the mechanics matter, but the human stuff, conquering fear, finding support, committing to learning, that's just as vital for actually succeeding and feeling confident about it all.
Wow. Okay, we really covered a lot there. Digging into those specific pages, 24 to 41 of The Money School, we hit that winning order, why investing beats just saving, anchored in the time value of money. We tackled those big fears, too old, not enough money, and saw that dramatic difference between starting at age 25 versus 35 with just $100 a month.
Yeah, and we got into the emotional weeds too, money trauma, imposter syndrome, clarifying ROI beyond just the financial return, and that realization that your 401k probably makes you an investor already. Plus the warnings against just rushing in, thinking about risk like Buffett and strategy like Stanford Wong.
And that whole historical journey. From the 1600s Dutch East India Company, its scandals and shares, across the ocean to the 1790s on Wall Street, the Buttonwood Agreement leading to the NYSE in 1792, then the telegraph and ticker changing the game in the 1800s.
Then bringing it up to date, the modern exchange landscape, NYSE versus NASDAQ, how brokerages are your supermarket, making buying simple with just a ticker symbol. That grocery store analogy, really clarifying things.
And definitely busting that Wolf of Wall Street myth. Hearing about the reality of the 90s open outcry floors, the author's 18-year-old perspective, the noise, the jackets, the AXE body spray, and contrasting it with the quiet computer-driven market today, backed by those stark employee numbers.
Yeah, the 5,000 down to 500 really says it all. And finally, bringing it back to us, to the human side, the importance of not going it alone, finding that accountability partner, and starting to break down that weird taboo we have around talking about money.
Exactly. This whole deep dive was really about pulling those specific potent insights from the source material you shared, hoping to give you, our listener, that solid foundation and historical context without you having to wade through it all yourself.
It's pretty fascinating, isn't it, how this section shows that while the technology of the market has changed incredibly since the 1600s, the fundamental principles, compound growth, the power of time, the psychology of fear and greed, those things are remarkably constant.
That's a great point. And thinking about that very last idea from the source that hiding our money lies hold us back from growing together, it really leaves us with a final thought for you to mull over. If connection and talking about this stuff is so key, who's just one person in your life you could commit to having a real, honest conversation about money with sometime this week?
Just one person? Could be a friend, family member, partner.
Yeah. Just starting that conversation, something to think about as you move forward on your own financial path.